Welcome to our deep dive into risk management and the critical importance of credit risk management in the banking industry. Ignoring risk management is like playing a game of Jenga with a blindfold on and a live badger shoved down your trousers. Exciting for a hot minute, potentially disastrous very, very quickly. We're focusing on credit risk, which is the risk that someone will borrow money and then decide they'd rather not pay it back. It's a tale as old as the invention of money lending. Over the next few chapters, we'll delve into credit risk indicators, the financial equivalent of those little red flags lifeguards stick in the sand when the tide is bad. So buckle up, grab your calculators, and let's dive right in. First up, the loan-to-asset ratio, which is how much of a bank's money is tied up in loans. A high loan-to-asset ratio is like having all your eggs in one precariously balanced basket. If even a few of those loans go bad, the whole thing could come crashing down. Now, let's talk about loan growth rates. If a bank's loan portfolio is growing too fast, that's a potential red flag. Remember the subprime mortgage crisis? That was a lot of unchecked loan growth leading to a global financial meltdown. Not exactly the kind of party you want to be invited to. Next up, unplanned or excessive growth. Unplanned growth puts a strain on resources, leads to rushed decisions, and creates an environment ripe for mistakes. Imagine you're a bank manager suddenly inundated with loan applications. You're short-staffed, overworked, and relying on coffee and sheer willpower. Are you going to meticulously scrutinize every application? Probably not. Now, let's talk about income. Banks that rely too heavily on income from loans and fees are like trying to build a house on a foundation of jelly. Diversification is key. Banks shouldn't rely on one source of income. It's just common sense. High loan yields. It's tempting to see high returns and think you've cracked the code to financial success. But remember, there's no such thing as a risk-free high yield. When a bank offers significantly higher loan yields, it's usually because they're taking on riskier borrowers. You wouldn't lend your friend who still owes you money the same interest rate as Warren Buffett, would you? Next up, large loan concentrations. This is when a bank lends a significant portion of its money to a single borrower or industry. If that borrower or industry goes south, the bank is left holding a very expensive, very messy bag. Now, let's talk about liberal judgment in who lax with their lending standards. They end up with a portfolio full of unreliable borrowers. It's like handing out loans like candy on Halloween. Speaking of dangerous precedents, let's talk about frequent exceptions to credit policy. This is when banks start bending the rules for certain borrowers, undermining the entire system. Frequent exceptions are like cracks in a dam that could eventually burst, unleashing financial chaos. Now let's talk about classified loans. These are loans identified as having a higher than average risk of default. A large volume of classified loans is like a canary in a coal mine. Finally, we have loan portfolios skewed towards lower internal ratings or unfavorable categories. A high proportion of low-rated or bad loans indicates poor risk management practices. It's a recipe for disaster. So there you have it, folks. By understanding these key indicators of high credit risk, banks can better manage their lending practices. Managing credit risk is about due diligence, careful planning, and a healthy dose of skepticism. Stay tuned for more insights on effective risk management strategies. The world of finance is a lot like a game of chess. If you don't know what you're doing, you're going to lose.